Brien Krank is here. Brien Krank is, of course, the managing partner at Collins & Krank, and he's my money man, and he ought to be your money man. And today's everybody's money man because he can tell us a little bit about what is happening in these markets. How are you, Brien?
I am fabulous. It's just a wonderful day to be active in these markets, to be enjoying Fargo, just to be, part of this state. This is a fantastic day.
That is, you're in a good mood.
I am in a good mood. The market's doing the right things, and I get to have a hand-dipped corn dog at the Fargo Street Fair for lunch.
Oh, there you go. Street Fair.
Love that.
I hate when they double up with the Red River Valley Fair and the Street Fair. It's so many corn dogs. You got to decide.
And so much deep fried food. Yeah, it's gonna be a tough week for me with all those treats.
I hear you. So the market is healthy?
The market looks fantastic. So you remember it was just last month or the month before that I was saying, wow, we've got the certain technology, AI related stocks were doing well. If you happen to own those 7, that was a good thing. But I was worried because it was only 7. And then it, basically opened up into more of technology was participating. And I said, well, that's great too, but we'd like to see the rest of the sectors, the rest of the market participate. And now we have that. You know what? We've got participation across the board in this market. And so that puts us in a position where, most things are moving in the right direction. And that's what we really wanted to see for a healthy market.
So give me some highlights that you really that really jump out to you.
Well, the biggest thing is just looking at the numbers themselves. Think about it this way, Scott. The NASDAQ 100, so the biggest 100 stocks on the NASDAQ, up well over 30% so far year to date. So that's fantastic. And then when you start plucking out some of those individual names, NVIDIA has been all over the news this year. They're up over 200% for the year. So your money would have doubled twice. Netflix, how many of us have a Netflix subscription? They're up over 50% for the year.
And they were hurting for a little while there because
they were.
Yeah.
Apple, one of the biggest companies in the world, up 40%. Sometimes they say those companies are so big they can't move. Well, guess what? It moved. It's up over 40% for the year. And it's not just technology and things like that. United Rentals, you see their stuff on every single construction site, up over 30% for the year. We're all using our Visa cards. That's up over 15% for the year. So plenty of opportunities to make money in this market.
Wow. And remind us what you said about CDs.
Well,
last time you were on.
So, everybody gets all excited about some of these CD rates. And, we were talking about how CD rates were in the high 4s, even some of them over 5%, which is great. If you've got short-term money, CD type money, I think it's great that we finally have rates that are comparable with inflation. But I reminded everybody back then, don't be distracted by the shiny object. We had just gone through a very difficult year in the or in the stock market. And so people were discouraged. And that's the time people want to get out of the market. I say, don't do it. Don't think of CDs. That's just the shiny object that's distracting you. I said, stick to your stocks. In fact, buy high quality companies. All of a sudden, that 5% CD doesn't look so good when you compare it to a broad market index that's up over 30% in just 6 months.
Yeah, great point. Now, there are minuses on the board, right? Not every stock is soaring right now. What should we be a little leery of?
Well, and that's good to point out. So, yeah, there's a lot of things that are down. The biggest health and beauty company in the world, Estee Lauder, guess what? They're down over 20% for the year. And that's after being down significantly last year. There's a lot of companies. Johnson & Johnson, the healthcare giant, they're down over 10% for the year, again, after being down significantly last year. United Healthcare had started to come back, so the big insurance company, but they're still turning back down and down 15% for the year. So you're right. You've got to know where to go in this market. Kind of a side note on United Healthcare. We'd actually purchased that for our portfolio and then quickly eliminated it when they came out and said, hey, by the way, our claims numbers are way higher than we anticipated. So think about it. We want to own a great insurance company, but we don't want to own it when they're paying out lots of excessive claims. Part of that is people that had put off procedures that they're now having now that COVID has passed. But the other part of it is, get this, Scott, they're talking about the number of pickleball injuries is on the rise.
I've heard that.
But it's affecting our money. And so we said we don't want to be owning those insurance companies when we've got all these pickleball injuries that they're going to have to pay for. But those are some of the examples of the negative side of the market. And that's what we do. We try to avoid those. If we're in those, we get out of those, and we try to stick to those things that are working.
Yeah, and this is a good time for a little commercial about Collins & Krank. Professional money managers, that are saying here's the pluses, here's the minuses. Let's stay away from those stocks not doing so good. Let's get you in the good ones. You're managing that day to day, minute by minute.
Absolutely. That's one of the biggest things that really separates us is we are portfolio managers. I've had extensive training, been doing institutional portfolio management for almost 25 years now. And that makes a big difference than what other people in the Red River Valley are offering when they're basically selling you a product. We don't sell you a product, we sell you a process. And then within that process, we move you into the winners when we can find them and try to avoid those losers on your behalf. We're active every single day in the market. When we see things that change the story or change the narrative, we react appropriately.
Brien Krank with us from Collins and Krank today, talking money in the markets on the program. I'm curious if you is this a rally that we're experiencing right now, or is this a bull market?
That's kind of the big thing that everybody is talking about. Everybody's sort of off to the races now. Like I said, the market rally has really broadened out, the rally being this nice uptrend right now. We're still operating under the assumption that we're in a secular bear market. And it sounds sort of counter to what I just got done saying. So I love what's going on in the market. But if you go back and you study the 1970s, when we had high inflation, we had rising interest rates, we had all of that. We were in a bear market that lasted for like 15 years, where the market indexes from the beginning of the 70s to well into the 80s did nothing, right? So you say, wow, it was a lost decade or more than that realistically. But there was incredible opportunities to make money because we'd see it run up really nicely, and then you'd cash some of that stuff out because it would come back down, and then it would run up again. So those little intermediate rallies or bull market run-ups, if you want to call them that, those are what we call shorter-term cyclical bull markets. I love those. We can participate in those. We can make a lot of money for our clients in those times. And then we have to start switching on the defense and saying, hey, let's get ready because we're probably likely to see a pullback now back to where we were or somewhere in that trading range. Because I do think, and we're still operating under that premise, that we're probably in a longer-term bear market with these sort of mini up cycles in between there. And the fact that right now everything is looking really rosy to me and that I'm saying I'm fabulous, that alone is sort of a warning signal to myself saying, okay, when everything feels good, Scott, that's when I start to watch out for little chinks in the armor that anytime now when things feel this good, when companies are going up that shouldn't, that's when I start to watch for a pullback in the market. And that could happen next week. Maybe it's next month, but we're on guard for that.
Interesting. So it's a bear market, long term.
I still think we're in a longer term bear market. I hope this rally proves me wrong. So if we go up high enough and if we have a nice little healthy pullback, but it doesn't wreck the uptrend and we continue to see things get better, not worse in the overall market environment, then I think that, I'll change our thesis and we'll say, hey, we now believe we're in a longer-term secular uptrend. But I don't think that the recession has come to pass yet. I don't think the Fed is done raising interest rates. The economy is still very, very hot, as we're seeing out there. And so I think that there's going to be some pain to come. And so we'll be ready for that. We'll move out of our real offensive stance and get into defense when we need to. And that's what makes us so good at what we do is we're willing to be tactical and we're willing to be maneuverable where we need to be. And so we do that on behalf of our clients.
We get questions from time to time when you're on about IRAs, individual retirement accounts. Contrast what an IRA can do for your clients versus a normal investment account. Which is better?
Oh, that's a great question. So which is better really depends upon your circumstances. But if we're just saying which one can I get, the most wind at my back, where am I going to get the best growth for my investment? If it's long-term money and we can put that into an IRA, you're going to be way better off. So just think about this. The main feature of that IRA is the money goes in there and then it continues to grow tax deferred until you get all the way into those retirement years. And if you don't really understand the significance of that, think about it this way. So if we just had a regular investment in a regular account versus a IRA account, and they were both generating a 10% rate of return, by the time we pay taxes to the feds and to the state on that regular account, you're down to about a 6.5 or a 7% rate of return. So it's reduced what you get to keep. In that IRA, you continue to compound at 10%. That's where it gets all of its power from. So if you take that and you stretch that over a long-term time frame, I can show you examples where that IRA, even if it's the exact same investment as the regular investment account, that IRA will actually end up with twice as much money in just 20 years time frame.
What limits are there?
So that's the thing. So the government recognizes this. They give us this great tool. They don't tax the IRA. They're letting it grow tax deferred. And so all of that is great. And so there's the big but. So what does the government say about that? So we're going to give you this tool. However, you can't just fill it with all of your money because they want to be able to tax your money. And so they limit that, right? And so they say on a regular IRA contribution, right now you can put in only $6,500 a year. And we tell our clients, max that out. If you happen to be over 55, guess what? You can put in $7,500 a year. That's the catch-up contribution. Otherwise, yeah, you're looking at $6,500 a year, and I would take full advantage of that.
Interesting. More of our conversation with Brien Krank from Collins and Krank, the Money Man, talking money and markets on what's on your mind. After a short time out, don't go away. Back with Brien Krank, the Money Man from Collins and Krank. So before the break, we were talking IRAs, and you touched on the limits, the max you can do, depending on your age, up to $7,500. To catch up, you get a little more there if you're over 55. What other rules are there? What other restrictions?
Well, the basic rules haven't changed that much. I mean, like I say, the government recognizes that this is one of the best tools that we have for accumulating wealth. And so we say, yeah, let's participate. Let's put as much as we can into that IRA or Roth IRA while we can. And so I always say max that out. The catch is that you can't take that money out until you're 59 and a half without paying back taxes and penalties. And so we always talk to people about, is this long-term money? Is this money you don't need until you're into your, retirement age years? If that's the case, then yeah, I want that money to go into investments inside of your IRA first. And then 72 comes up a lot. That's the old 70 and a half that you used to hear people talk about. But why that's a key date, even if you're in retirement and you're saying, hey, I'm just going to let this thing go. It's going to continue to compound, tax deferred. I love this thing. The government says, whoa, 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 whoa. We want to be able to tax that money. We gave you a break all through your working years. And so at age 72, they're going to force you to take out some of it. There's a calculation we do depending upon your life expectancy, and you got to take some of that out. And people say, well, why do I have to do that? The main reason is the government wants to tax your money.
Of course they do.
So that's what they're doing. And so when we talk about doing, financial planning for clients, it's not just, how much do you need to live on or how much are you going to pass on to your heirs? It's really also about, when do we take money out of the IRA? How do we do it in a way aligning with some of your other money so that we don't put you into a higher income tax bracket? How do we make your IRA last as long as we can so you continue to get that tax deferral? That's all part of the financial planning process that we do for people.
There's an AARP article that's come out. You told me a couple of your clients have asked about it. It talks about some concerns when you inherit an IRA from someone. What do we need to know about that?
Well, so that's important too. So when you get an IRA, the government would love it. You inherited an IRA, maybe it's from your grandparents or your parents or even from a spouse. They would love it if you would just cash that thing out and put that money somewhere else or go spend it. Because guess what? You're probably inheriting an IRA that's, multiple hundreds of thousands of dollars, and all of a sudden they get to tax that. And whatever your current income is, if you're making, $80,000 a year and you inherit an IRA for $250,000 and you cash that thing out, guess what? You just got ramped up into one of the highest tax brackets. You might as well just cut a check for half of it and give it away, because that's basically what's happening, is that money is going to be going to the government. Those are big paydays. So we sit down, and again, part of that financial planning process we do for our clients is we explore what the other options are. So for instance, they also can say, we're going to take this and we're going to stretch it over 10 years. And so we'll work with them to say, what is your income, your regular income, going to be in that next 10 years? And we'll slowly bring that IRA money out from their inherited IRA over the next 10 years in a careful way so we don't push them into a higher tax bracket. But they're given 10 years is all before they have to get that money out of there. So that's an important consideration. If you happen to be a spouse inheriting your wife or husband's IRA, there you get a little bit different benefit. So you can do everything that we just talked about. You can take the money and run. You can stretch it out over that 10-year time frame. You can also, as a spouse, roll that into your name, roll it into your own IRA. And now that money can continue to grow tax deferred until you have to take those required minimum distributions. But one of the big advantages of working with Collins and Krank is we're going to do a complete financial plan. We call it a goal plan. We're going to do that for you. And then what we're going to do is we're going to say, okay, what is the best way that we can help you get those distributions from your IRA so that we can keep that money growing tax deferred, but also keep your taxes at a minimum.
And you have that conversation, you do that goal plan, and you watch it work. And I think anybody listening for the last half hour knows that to have someone like Brien managing your money in the market, doing it, which is very unusual, is a real plus. It's a real benefit for you. So Maria and I love it. We are big fans of Collins and Krank and encourage you to do the same.
Thank you, Scott. I appreciate that. And yeah, we're happy to do that for other people too. So give us a call at the office. We'll sit down and walk you through that process and show you what that looks like.
701-235-0119, 701-235-0119, or collinsandkrank.com.
Absolutely. And you can find us on all the regular sites. We're on LinkedIn and Facebook and Twitter and all those, and we even answer questions through some of those sites.
I think the key thing is just to have that conversation. Call in, have the conversation, get to know a little bit more about Collins and Krank, and you'll quickly realize this is going through that planning process is really invigorating.
Absolutely.
See the goal line.
The goal line, and then as we always say, stick to the plan. People will call in times of adversity and say, hey, should I pull that money out of the IRA now because it went down or did this or this tax law is changing? And we always go back to that planning process. And what do we always say?
Stick to the plan.
Right
yes,
on.
Exactly right. Thanks, Brien.
Thank you, Scott.
Brien Krank from Collins and Krank on What's on Your Mind, the Money Man. God bless you, folks. See you tomorrow.